Hey guys, welcome to another YouTube video in the Defined series. And today we'll be talking about fair value gaps. This was one of the most easiest PDRA for me to understand aside from other block. And that's because it just means it's just so easy to spot in the market, right? So what are fair value gaps? From the name fair value gaps, you could easily denote that it's all about gaps. Okay. Okay, so the psychology around the formation of this fair value gap is that when the market is about to reverse, either from a bearish to bullish or from bullish to bearish, one of the key indicators that we want to see in the market is the formation of fair value gaps. And that simply means that we have institutional buyers or sellers in the market. So let me give you an analogy. If you throw an elephant into a small bathtub with water, what happens? The water displaces quite very rapidly compared to when you throw a stone into the bathtub. You will hardly see any displacement there, right? This is because the elephant is huge and big in mass, right? That is why it's coming in contact with the water in the bathtub is going to displace the water very, very quickly. That's the same thing with fair value gaps. So when the elephants, the institutional buyers in coming to the market, they come in with their large orders. And one of the key signatures that they are here now is that we have massive displacements in the market. These massive displacements in the market leave fair value gaps. Okay, so like the image in front of your screen is denoting already. Okay, you could see this is a bullish scenario and this is a bearish scenario. So a fair value gap is just a series of for a bullish fair value gap, a series of three up close candle overlapping each other, and in a bearish scenario, a series of three bearish candles overlapping each other. Because of the huge massive displacement in the market, when we see signatures like this, what usually happens is that the market leave gaps like this. So distance the distance between, I'm going to use green for this, the distance between the first candlestick, right, and the last candlestick in this three candle series is what creates the fair value gap. So we have this candle, the one in the middle, right, and the one at the end. This is the beginning and this is the end. The gap inside the middle is the fair value gap, and it is spotted by the difference between the high of the first candle and the low of the last candle in the three candle series. The same thing is applicable to the bearish here. Okay, everything I just say for the bullish is applicable to the bearish scenario. Okay, and this is just basically what a fair value gap is all about. Exactly, this is just exactly what fair value gap is all about. So, first off, the question is, how is it formed? It is formed when there is massive displacement in the market. So you want to note that down. That is the psychology behind its formation. And what we generally expect is that price comes back to fill this gap and continue its uptrend movement for buys, and for sales we want to see price fill up this gap, right, and continue its downward trend movement. Okay, so understanding this, let's go into the chart to find examples to further give you an understanding of what is going on here. So before we leave this image here, this is a bearish trend, and fairly gaps almost always occur during periods of reversals. When the market is about to reverse, that is when we see fairly gaps formed most of the time. And whenever, and these are key signatures that okay, price is about to actually reverse, because what this fairly gap normally does is that it's almost always breaks structure, right? It almost always breaks structure. And the structure signifies to us that we have switched a trend from being a bearish trend now to a bullish trend. Okay, so with this in mind, we are going to be going to the charts to find examples like this. All right, so let's go to the charts. Okay, so we'll start with the bearish fair value gap. Already from my screen, I hope it's not even so hard for you to spot these things. And a quick disclaimer, or a quick, let me call it disclaimer. Let us say a quick note for your notes. Fair value gaps is, we have breakaway gaps, and these breakaway gaps are fair value gaps that were not filled, and this is almost always constant in the market. Fair value gaps that are not filled, and another note to take in is that in the bearish market, you want to be looking for bearish fair value gaps, not bullish fair value gaps, because they offer continuation to the trend, already existing trend in the market at the time you are engaging the market. Okay, so you don't want to be looking for bearish fair value gaps in the bullish market, and you don't want to be looking for bullish fair value gaps in the bearish market. And you need to take that down. That means you need to understand your bearish and bullish market structure, and the video for that is already on the YouTube channel. The first example I have on my screen is this fair value gap here. As you guys can see, it wasn't filled. This is a breakaway gap, but it is still a fair value gap regardless. Okay, why is it called breakaway gaps? Because it was left unfilled. Why was it left unfilled? Because there is just too much volatility in the market at the time. What caused this volatility? The introduction of the institutional buyers with their high volume of liquidity. This is what caused most of, which this is what causes most of the breakaway gaps we have, or if not all of them at. So you could see this gap was left unfilled, and this is the 4 hour time frame. This is also a fair value gap too, right? This is also a fair value gap too. Series of down close candle, right? So this is candle one, candle two, candle three. The distance between the low of candle one and the high of candle three is the fair value gap that I'm noting here. Candle one, candle two, candle three. The difference between candle one's low and candle one's high is the bearish value gap I'm denoting here. And the same thing goes for this as well. Now let us see examples of fair value gap that were filled. This was a fair value gap, right? And this gap was filled. And notice how price left this value gap, immediately it got filled. That is what you want to see when you're interacting with fair value gaps. Okay, this candle one, candle two, candle three, right? The difference between the candle one's low and the candle one's high defines the bearish fair value gap. And you can see price retrace into this fair value gap and displaces downward. We have another example here. Candle one, candle two, candle three, candle one, candle two, candle three. This difference between the low of these candle ones low and the high of candle three is what created this value gap. As you can see, price mitigated this gap, ranged a little bit inside the gap, and displaced lower. Okay, so we have another example here. Candle one, candle 2, candle 3. Okay, so here, and you can see price, every time price approached that gap, it left the gap and displaced lower. Okay, so we have candle 1, candle 2, candle 3, and the gap between the low of candle 1 and the high of candle 3, so it qualifies a bearish value gap, right? And you can see how price, even when price came back again here, we'll see how price reacted off of it and displaced lower again. Okay, now we have this other example here of a bearish breakaway gap again. You can see this huge candle here. This is a type of value gap which is known as volume imbalance. This is a type of value gap which is known as volume imbalance. Why? We have, compared to all these other gaps we are talking about here, you can see how huge and big this candle is. This is a volume imbalance, okay? But it is also a type of a value gap, okay? So there will be videos explaining different types of fair value gap. We have breakaway gaps, we have volume imbalance, and we have the inverse fair value gap. Okay, so I will try and make this very easy and simplify it for you. This is another fair value gap here, right? A bearish fair value gap on your screen. This is candle 1, candle 2, and candle 3, right? The difference between candle 1's low and candle 3's high is what created this fair value gap here. Can you spot another one here? Yes, I know you spotted it. Candle 1, candle 2, candle 3, right? Exactly, exactly. Which other examples can you spot here? Yes, you can see this as well. Yeah, candle 1, candle 2, candle 3. The difference between candle 1's low and candle 3's high, fair value gap. Can you spot another one here? Of course you can. Here, send the example here. Beautiful, beautiful, beautiful. Can you spot another fair value gap here? I'm sure you can. There. Now, let me use this opportunity to introduce to you what an inverse fair value gap is. Now, I want you to take note of this bearish fair value gap that was formed here and see how price related off of it when it first mitigated it. Price sold off from it. The second time price came into that gap, price sold off, ran into a fair value gap, which is what now? A bullish fair value gap, right? This is now a bullish fair value gap. Can you see how price switched from being bearish to being bullish by displacing above this bearish fair value gap here as well? Can you see that? Can you see that bearish fair value gap here? Yeah. Now, this bearish fair value gap that was displaced, right? Normally, what do we expect when price interacts with fair value gaps? We want to see price get into this bearish fair value gap and sell off. But instead of price doing this, it did the opposite. Price got into that fair value gap, displaced it, and created a bullish fair value gap while displacing it. When I mean displace, I mean traded above it, went higher than it, and did not reverse from it. That's what I mean by displacing. Now, this bearish fair value gap that was displaced was now used to push price higher, as you can see here. Now, this changes this from a bearish fair value gap to a bullish inverse fair value gap. To a bullish inverse fair value gap. A displaced fair value gap is an inverse fair value gap. So this fair value gap that was displaced, this was a bearish fair value gap now used as a support. So how many of you know what is support and resistance? Exactly, that's what it is. This now that was a support now turned to, this was a resistance now turned support. This becomes an inverse fair value gap. I hope you wrote that down in your notes. Okay. So now this is I will find bearish inverse fair value gaps. This is a bullish inverse fair value gap. Why? It turned a bearish resistance into a bullish support. Can you spot another fair value gap here? Yes, you can. This is a bullish fair value gap. All right. And can you spot another inverse fair value gap here? Yes. This bearish fair value gap that was used to send price lower at the initial contact with it got displaced above it and was used to send price higher a bit. This becomes an inverse value gap, but it failed. It did not hold price. And why didn't it hold price? Because we were in a bearish market. This was just a retracement to continue trading lower again. That is why I said in a bullish market, we are we buy until price meets its objective and it begins to reverse. In a bearish market, we sell until price reaches its objective and we begin to reverse. In this case, price was retracing because already right from this high, we're in the bullish trend. I'm going to zoom out so you could see what I'm talking about. You could see that right from here, we've been bearish, extremely, very, very bearish. Now, price gets here, put in some form of retracement to take out this high, right? What was the objective for this retracement? This high here. And as soon as price met the objective, which was this high, what did price do? Price started displacing. What is the easiest target for price during retracement? This low that was formed here, because this was the low that put up this high. I explained this in the market structure video. I explained this in the market structure video, and I want you to go back and watch that video if you don't understand what I'm saying. Right? So this was just a minor retracement to take out external range liquidity, and price came back to take out external range liquidity low. When we talk about liquidities, you understand better what I mean by external range liquidities and internal range liquidities. Okay, the video will be out soon, so expect the video soon. So we have another example of a bearish value gap here, and I know you understand why it is a bearish value gap. Yes, you do. Yes, you do. Okay, now I want you to take note of this. Price was bearish until price met with its objective, right? And this objective could be many things. One of the core objectives of price trading high or trading low is to take out. If we are bullish, the objective of this bullishness is to take out highs. Remember, we are breaking highs in the bullish market. If we are bearish, the objective of the bearishness is to take out lows. Remember, we are breaking lows when we are bearish. And price traded low from that high up to this point and began to reverse. Now, I want you to take note of how this reversal began. In this low here, what happened? What can you see here? A bearish fair value gap that was displaced above, and this displacement left a bullish fair value gap. What is this bearish fair value gap now referred to? It's referred to as what? A bullish inverse fair value gap. And what happened? Price created this bullish fair value gap, candle 1, candle 2, candle 3. The difference between the high and the low of candle 1 and 3 is what creates the bullish fair value gap. And then we began to trade higher, right? See another fair value gap here, bullish. Yeah, right? And what is this series of down close candle called? That's right, order block. Order block. please see the video on order block to understand what I just said. Order block. Okay, and then price displaced higher again, leaving this bullish fair value gap. Right, price displaced higher again, leaving this bullish fair value gap. Right, price displaced higher again, leaving this bullish fair value gap. Now, price is bullish until it meets its objective, and then we begin to reverse. Can you see that? Can you see that price started reversing again? And where the price reversed to? Price during the reversal, we can see price creating this bearish fair value gaps here. Right. Now I want you to take note of this. Look at this bullish fair value gap. I'm going to zoom my screen. Look at this bullish fair value gap here. And I want you to see how price displaced below it. Immediately price displaced below it and created a gap, a bearish fair value gap. What did this what is this bullish fair value gap now referred to as? Is referred to as a bearish inverse fair value gap. Why? It was a bullish fair value gap that was supposed to hold price supposed to retrace into this gap and push higher. But instead of price doing that, price retraced into it and then displaced lower below it. Now, this will now become a point of reference, which is a support turn resistance zone. If that makes any sense to you. I don't use those terms, but those terms are still very, very valid in trading. And you can see after that, can you see another inverse value gap here? A bearish value gap, which is supposed to hold price, getting inversed, right? And price use this resistance and turns it into a support zone for price to trade higher, right? So that is just basically what an fair value gap is all about. And I hope you understood this lecture because it's very easy to me. I feel like it's very easy. Can you see another fair value gap here? Yes, this is fair value gap. Okay, a fair value gap. All right, we have another fair value gap here. Can you see this inverse fair value gap? This resistance turn support. Can you see it? It's supposed to hold price and send price lower, or price displaced above it, creating what? An inverse fair value gap. Okay, yeah. It, and because it is used for bullish price action, it is now what? A bullish inverse fair value gap. All right. So this is just uh, the intricacies of fair value gaps, and I hope you understand what this is all about. As you can see, these value gaps are mostly forming when price displaces. What is displacement? We are switching from being a bearish trend to a bullish trend, or we are continuing the trend. It is used for to denote reversal, and it's also used to get into the market for continuations, right? So we have this candle 1, candle 2, candle 3. The difference between candle 1's high and candle 3's low is the bullish fair value gap. Okay, so we have this breakaway gap here that price did not fill, right? Price did not fill this gap, but it is still a valid fair value gap. So something for your notes. When we have two fair value gaps overlapping each other like this, you want to be mindful of the first fair value gap while taking into consideration the possibility of price trading below the first fair value gap. Now, the assignment is this: go into your charts and mark out fair value gaps, both bullish and bearish fair value gaps. Remember to align your search for gaps according to the trend of the market that you're looking at. Until next time, happy trading.